Hi, it's Chris Titley, and as part of the Sub-11 Uncovered series, I'm joined by Patrick William, co-founder of Rixon Capital. Patrick, thank you so much for being part of this series.
Thanks for having me, Chris.
Patrick, for the listeners out there that know nothing about Rixon Capital, can you give us a bit of an understanding of how the business began and what it does?
Yeah, so Rixon Capital is a private credit fund. There's a private credit fund in every street corner, but we're reasonably unique. So what we realized was there's a real opportunity to provide non-dilutive funding to emerging corporates. So most funds in the market are either property lenders or they're looking to do large loans, $15, $20 million as a minimum. We focus on check sizes of $1 million, and we do not take equity warrants. So we've got a really neat niche, and that ties in very well with our origin story. So I came from an institutional banking background. My co-founders are very well known in your circles. It's Luke and Dallin Howes and Blair Murphy from Proviso fame, and they've exited fintech entrepreneurs. And they saw an opportunity to provide debt funding to really high-quality emerging corporates, where you got great downside protection as an investor. You can generate a really good yield, but you're not actually banking high-risk businesses. They're just small.
And Patrick, when it comes to the sources of funding, a lot of people talk about equity and a lot of people talk about venture, and it's all very popular, but not a huge amount of people talk about debt. Can you talk about the advantages of debt and how you fit into a company's capital structure?
Yeah. The best part about debt is it doesn't grow. If you take $5 million from us today and you quadruple in size, you still owe us $5 million. So the beauty of that is you take in a slice of debt. We rank ahead of equity. So if things go wrong, we're first in line. But on the flip side, if things go really well, we just get back what we put in. So what's very appealing for you as a founder is if you've got a business that you're looking to grow, if you've got a good quality business, you'll have potential equity investors around the block, all looking to take some of that upside and share it with you. Your challenge, of course, is you're at a spot where you've got operating cash flow, perhaps you've got assets, and you go, look, I don't want to keep giving away this equity. What can I do? So if you've got assets and cash flow, Rixon's the fund for you. So you turn up and you say, look, I need $2 million to buy some kit, to fund some working capital. We come in, we give you that $2 million, we rank ahead of you, but you can keep growing using our capital. All we want is our monthly interest payment. At the end of 12 months, at the end of 24 months, you can repay us or you can swap out to a bigger facility. But all that upside is yours. So we have no interest, or our investors have no interest in that upside. All they want is a comfortable yield while they're there and comfort that if things go wrong, they're getting their money back.
And Patrick, can you talk about the progress of the business from inception, that first deal you did? You probably remember it very clearly, and how the business has gone thus far?
Yeah, look, that's a great case study. So it's a business called WageTap. It's no secret. It's on LinkedIn, and I think they did a bit of marketing when they came on board. It's a business that it's an ethical wage advance player, very small loans. When they came to us, they're doing $100 to $300 advances on your wage 2 weeks before you're due to be paid. So they had a $2 to $3 million loan book funded by shareholder debt. And the shareholders said, look, you've got really low loss rates. You're a really well-run business. Go and get yourself a big fat debt facility and let's grow. They went to the banks. The banks said, come back at 100 mil. The big credit funds said, come back at 20. And the family offices all said, look, we'll back you from day one. We'll also take 10% of the equity and come along for the ride. Enter Rixon. We saw them for what they were. A very well-run business, very well-diligence loans, very low loss rates. So we said, look, we'll give you a $15 million facility on day one. They drew $2 to $3 million up front, and every month they took $500,000 to $1 million as growth emerged. They stayed with us for about 18 months, and they refinanced about mid this year. We haven't got the details, but I speculate they've got a $40, $50, $60 million facility, and they're off the races, right? Substantially larger business, very, very valuable equity. And all Rixon got out of it was a steady interest payment over those 18 months and a handshake and a friendly email at the end, which suits us fine.
Yep, no, exactly. And just on that, I was just thinking in my head what types of industries and businesses would be appropriate for Rixon. Are you talking about companies that require, lending or marketplaces, or are they traditional businesses, as you mentioned, to provide, working capital or equipment, for instance?
Yeah. So our ideal is not the right word. We're seeing a lot of demand from emerging fintech lenders. So we've got 4 or 5 in the books at the moment. It's a very easy sell for us. It's a formulaic lending model. The fintechs tend to be very well structured. It's very automated. So that's a core target market for us. But by and large, if you're a business with cash flows, regular revenue, and some form of assets, plant, property, equipment, or receivables, we look at you. I tell people, don't be shy. If you're vaguely within the ballpark, reach out. You'll be surprised at the things we can structure for you. As an example, we did a loan last month. Sorry to interrupt, Chris.
No.
Entrepreneurs bringing in very, very interesting kit from equipment from North America into the Australian market. They needed funding over that equipment, and the contracts were waiting there. So they said, look, our cash flows are low, but as soon as this kit arrives in Australia, cash flows are going to be flying. The only way for us to fund this kit is to sell all this property we've got. So we said, look, how about this? You hold on to that property. You give us first and second ranking liens over your home and your investment portfolio. We'll take registered liens on the equipment when they turn up. And then when it all works out in 12 months, we release everything. So the beauty for them is there's not much money out the door, but they're getting this big facility to bring in this really interesting equipment. But for us, A, we have security, so things go wrong, our money comes back. B, they're servicing our interest every month. So there's a win on both sides.
Absolutely. I'm interested to know also in the macro environment, we've seen a lot of quote unquote down rounds. We've seen the growth at all costs in 2020 and 2021, where some founders may have taken some money at a large valuation. Now they're sort of growing into something a little bit lower. Can you talk about the impact of dilution and then how that is such a big thing right now?
Yeah, look, we're fortunate to be a lending business. Like, we've got friends and borrowers in the tech space, and the impact of a down round, an impact of any equity raise is dilution. The impact of a down round can be devastating on the core founding team. Right? You need this money to come in, and at some level, you feel like you've lost the business. That's really appealing for us if you've got that asset base, or very appealing for the borrower as well, because you turn up and say, look, I just need that $1 to $2 million, and I don't want to give up 3, 5, 10% of my business. I've given up way too much already. So again, another good case study is there's a business we funded early this year, reasonably large. They had a $1 billion fund put in a substantial equity check, taking 40%, and they had a working capital challenge, and the market wasn't that flash. Because the working capital gap was only $2 million, no one wanted to come and bank them. And the big fund out in New Zealand said, look, very happy to cut their equity check, but your valuations come off. We'll take another 5% for this $2 million. And thankfully, through the network, they heard about Rixon. We turned up and we gave them a $5 million facility. They've drawn to 3. The founders still hold their 60%, and the business is doing very, very well.
And Patrick, when it comes to education around Rixon, the types of the debt you provide, the rates, the costs, etc., how are you going about in terms of educating the market and getting out there to say we are a viable option?
We've historically depended very much on personal networks. I've done this for a while. Luke and Dellenhouse and Blair Murphy are definitely living and breathing the ecosystem, so we had plenty of referrals from them. But we're beginning to be a bit more proactive. So speaking to people like you who are very well linked in the space. I met Brandon from Fintech Australia just this morning about joining as a member. As he put it very well, you're offering this amazing solution where on the equity side, they go, look, I don't have to give you 10 million. I give you 2. Rixon will bridge the 8 and we all win. And from the borrower standpoint, it's the exact same thing, right? I don't have to dilute myself anymore. If I've got the assets and the cash flow, Rixon can come in. I can stick with my 10, 20, 30, 40%, and we can grow together without me diluting further.
And Patrick, you mentioned early on that you did that first deals around $15 million, and there's probably some recycling of that, as you mentioned, that they've paid that back plus interest. Can you talk about the book now and the loan sizes that you are doing now here in late 2024?
Yeah. Look, as of next week, we'll have a portfolio of 12 loans. They range in size from $1 million to $11 million. So we're not precious about doing the smaller loans. What we like is growth. So we wouldn't do a one-off $1 million loan, but what we would do is give a business a facility of $3, $5, $10 million, but allow them to start with even as low as $500,000. Not ideal, but we'll do it for the right business. But what then happens is, A, they've got an uplift in the equity valuation because they've actually got a facility. B, it allows us to monitor them. So we'll give you a small check on day one. And we see, look, you're paying your interest on time, you're performing the right way, you're going the right direction. Then we're very happy to start giving you larger and larger checks as you grow the business, all debt funded.
And Patrick, in terms of the duration of loan, is that pretty flexible or is it reasonably fixed?
Definitely very flexible. We've got a minimum term of 12 months. The message to investors, message to borrowers is we do a lot of work to make sure you're the right fit for us. Our investors put the money out the door expecting it to generate a return for a minimum amount of time. So look, so long as it's a 12-month minimum term, you're definitely for us. We don't go above 3 years. And I tell borrowers who want longer terms, you don't want a facility for 5 years either. You want something reasonably short and sweet where we take you on a journey and then we're having a conversation about either leaving you or upsizing you.
And before companies come to you and you're part of your due diligence process, what do you suggest to them to sort of get their books in order to show you, for you to be able to process a loan?
Yeah, it's an easy sell to the fintech space because, as I like to put it to my investors, the beauty of fintechs is when they come to us for a $3 to $5 million facility, in their mind, it's a stepping stone to that unicorn status. So they tend to be really up to date with their numbers, but assuming they're not, get that investor presentation up to date, because the key point for us, the key hurdle is we want to understand your business and revenue model. Because if it is very high risk, if it is very cyclical, it may not fit our mandate. If it is, and it is a fit with us, try and get that message through to us very quickly, because that allows us to progress in diligence very quickly. The second point is just being up to date with your numbers and your balance sheet.
Yeah, I was going to say from loan number one that you did, or deal number one that you did, to where you are now, if we repeat this podcast in 12 months' time, where would you like to see the Rixon Capital business be at?
Well, the fund will close next week at we'll close our numbers next week at $70 million funds under management. In 12 months' time, we'd love to see that at close to $150 to $175 million. There's plans in the work for a second fund strategy, but that's very early days.
And in regards to the investor side, there's investors in your fund. Are they receiving a regular income?
So we're an income-only fund, so we pay a regular monthly yield. It hits the bank account like clockwork on the 6th business day of the month. Funnily enough, while we're called the Rixon Income Fund and we're an income-only fund, 40% of our investors choose the reinvestment option. And very cleverly so, because you're getting a compound benefit. So our last 12-month return on a cash basis was 11.5%. But if you're compounding, it's well north of 12%. And
Patrick, it wouldn't be a podcast without talking about AI and the actual macro trend of what's happening. Some of these businesses, obviously, they need to change and they need to potentially use AI to get efficiency gains. What are you seeing in the market, and in particular fintech, where some of these businesses might require a bit of a shift or might require some capital to kind of get their business going?
Now, that's a very interesting question. So if you look at the businesses, so I think AI is at that stage where it's a very, very clever tool with plenty of opportunity. We haven't seen it come up much, and I imagine it's because if you're starting a young business, as an equity holder, I'm probably more comfortable knowing it's a formula that Chris built and it's a model that Chris built and it's a document that Chris drafted. So I think the real value of AI is once you hit a bit of maturity and investors that equity and debt are comfortable with your model, then you switch that AI component on and start really generating efficiencies.
And I think last count, there was probably something like 700 or 800 fintechs floating around, maybe more. I don't know. It's hard to keep up, but there's a lot of news happening in the fintech space. What do you suggest for some fintechs, and how do they reach you, and how do they contact you?
Yeah, it's Rixon.capital. That's the website. Follow us on LinkedIn. We're very, very active. We take pride in being very approachable. So what I always tell potential borrowers is we're not time wasters. So if you come to us saying, look, this is what I do and this is what I need, you'll get a yes, no, or next steps, generally within 72 hours. What we've learned from life experience, even setting up our own fund, is nothing worse than someone taking you on a journey with the intention of saying no in 3 months, but making it look like they tried. We're much better. People are much better off getting a quick no. B, we're also not precious about directing you to someone else if you're not a fit with us. So, we've got businesses that have come to us way too early for any sort of debt. And we said, look, here are 3 really good advisors we know, well-regarded, good operators. They'll help you raise a bit of equity first.
Fantastic. And I suppose from that, speed is of the essence when it comes to fintechs and startups, and any sort of delay. And I was chatting to a startup the other day saying that they were waiting on an investor, and it was sort of this process, this DD process has gone on for 2 months now. And 2 months is a long time in startup world. So the fact that you can actually give that answer, which is potentially yes or a straight no, pretty quickly, I think is material and probably underestimated in this market as even with things like AI, speed is of the essence.
Yes, and it also comes down to process. So that our record is 3 weeks from first conversation to $3 million out the door. So check
wow.
sizes of up to so for check sizes of up to $3 million, look, if your ducks are lined up and it's not Christmas or January, we can probably get you the money in 3 weeks. Yeah.
Yeah, Melbourne Cup to Australia, as they say. It's coming up soon as well. So, Patrick, thank you so much for giving a bit of a snapshot on Rixon Capital, the ideation of where and why you founded the business, the sweet spot that you play in, particularly with the aim of getting some more fintechs on board, and also the progress of the business thus far and some of the future plans. I really appreciate you coming on the Sub 11 Uncovered podcast and looking forward to catching up.
Likewise. Thanks, Chris.